Good morning, everyone, and welcome to today's presentation on advanced 1031 exchange strategies. My name is Jeff Stechmann. I'm the Eastern Regional Manager for Asset Exchange Company. Before we kind of dive in, I just give you all some information of how we're going to handle today's presentation. Don't feel like you have to write every single thing down. All right. Today's presentation is being recorded, and you'll receive a link to today's recording if you want to refer back to any of the topics that we're going to discuss today. And then some of the topics that we're going to discuss, I actually have in just like single page PDF form, because I find a lot of times if you're a realtor and you have a client, you would love to be able to have some information to be able to email or forward on to a client. And those PDFs, I'm going to send them out to everybody via email, and I'll have some information in the body of the email that you could easily forward on to a client. Now, you might want to pick which which PDFs that are relevant to your client. So don't feel like you have to write every single thing down. And that email, what some realtors do is they'll even include me on the email, introducing me to their client, and then I can follow up with any questions they have. All right. If that works for you, hey, it works for me. And as far as questions go for today's presentation, I'll open the floor up to questions at the very end of the presentation, because I find a lot of times if you have a question, most often it'll be answered in an upcoming slide. But again, if for some reason it isn't, at the very end is where we'll open the floor up to questions. All right. Kind of give you a little bit of some background about myself. I've actually been in the business for 28 years. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if you hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I've lived in Florida. I lived in the Tampa Bay area of Florida for 25 out of those 28 years. And, as long as I've been doing this, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And, hopefully we never have to go through those hard times, those bad times again. The market it has been a little slow the past few months, but I can see now. I mean, it's really starting to pick up, especially this month. And this is typically kind of when things pick up, March, April. So we'll see what the rest of the year has entailed for all of us, right? Now, let me give y'all some information about who we are. So we're Asset Exchange Company. Now, we've actually been in business since 2006, and over the course of our existence, we've done about 40,000 1031 exchanges. So it's all that we do. All right, we don't provide any type of closing services. We don't provide any type of financial services. Now, in the business, we're known as a qualified intermediary, QI for short. Now, some other terms you hear people refer to is an accommodator. Another common term is a facilitator, or just simply an intermediary. But again, most often people just refer to as QIs. Now, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. Well, we hold the proceeds from that sale on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. All right. If they ever do, they would lose their ability to do a 1031 exchange. And we're going to talk about that in greater details in some upcoming slides. But just a word of caution about QIs. It's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So, what exactly does that mean for everybody out there? Well, what that means is anybody can be a QI, right? There's no type of requirements you have to have any type of E&O insurance. There's no type of requirements you have to have any type of bond. There's no guidelines on where you hold the proceeds or the type of funds you hold the proceeds in. It's a really scary thought when you sit down and think about it. So If anybody on the line today is currently involved in a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. Now, great news when you deal with us, right? Well, we're actually based out of California. Our home office is in San Francisco. And because we're California based, well, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California, right? They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. We're subject to audit by that franchise tax board. There's guidelines on the financial institutions where we hold the proceeds. There's guidelines on the type of funds we hold the proceeds in. Which is great for anybody that deals with us in California, right? But anything that we do, any exchanges that we do in any other state, that franchise tax board has oversight in any file that we work on, because as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on, any exchanges in any state, all right? So, you do have some assurances when you deal with us. And then as far as our ownership goes, we're actually owned by two gentlemen. Now, they've been in the 1031 exchange business specifically for like 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is considered like a 1031 exchange expert. He's been called upon to testify in a tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. Now, the whole reason I like to bring his name up is because, one of the things that we offer that, honestly, I don't know any other QI in the business offers is if any of the exchanges that we're involved with, if for some reason they were to get audited, we would actually provide audit support. All right? We'd work hand in hand with the client's CPA, helping to defend the audit. And it primarily would be done by our tax attorney owner, Adam Skarsgård. So another great reason to deal with that. Now, let's talk a little bit about why do investors exchange? Well, the single most obvious reason that we see is for tax deferral. So, when you sell real property, if you have any gain in the property, all right, on average, about a third of whatever that gain is goes towards paying taxes. And that's the single most reason that we see investors utilizing 1031 exchange is to defer those taxes. But what are some of the other things that we see? Well, next bullet item, I call it buy more property. So with exchanging, one of the rules to exchanging is the property that you purchase in a 1031 exchange, the purchase price of that replacement property must be at least equal to, or it can even be greater than, whatever the sales price was on the property that was sold, the relinquished property. So what an investor will do is, by utilizing a 1031 exchange, by utilizing that tax savings where, no longer do they have to cut that check for the taxes, they utilize that as leverage to go out and buy themselves a better property. Now, hopefully it's going to be a higher dollar property for them, and also hopefully that's going to equate to a higher income producing property for them, all by utilizing the tax savings of a 1031 exchange. Now, what are some of the other things that we see? Well, diversification and management relief is another thing that we see investors utilizing 1031 exchange for. With exchanging, you're not limited to how many properties you can sell in an exchange. You're not even limited to how many properties you can purchase in an exchange, right? You could sell one property, buy one replacement property, or you could even sell one property and buy multiple properties, or sell multiple properties and buy a single property, or buy multiple properties. It doesn't matter. All right, what matters, and we covered this in the basics class earlier this month. What matters with 1031 exchange is the property that you're selling. It has to be real property that either you use in your trade or business or you hold for investment. And you got to buy as replacement property any type of real property that you use in your trade or business or that you hold for investment. All right. So geographic diversification is something we see investors utilizing 1031 exchange for. I'll give you a quick example of maybe the way that could work. Let's just say, let's say you own an investment property in a state maybe like California. Now, California has some of the highest property values in the entire country. I want to say where our home office is in San Francisco. The average sales price for property in San Francisco has now actually exceeded the average sales price for property located in New York City. All right, so you got that investment property located in California, right? Now, you do a 1031 exchange, you defer your taxes, but instead of buying investment property, a replacement property in California, you say, you know, maybe I'll buy one replacement property, let's say maybe here in Florida where I'm located, and then maybe you'll buy an additional replacement property, maybe somewhere like in a state, maybe like Texas. And if you have enough, maybe you'll even buy an additional property, maybe in a state, I don't know, maybe like Ohio. Because why? Because you don't want to be so geographically tied in to one particular real estate market. Because hey, who knows? if our real estate market here in Florida starts to go down again, well, at least you have that additional property in Texas and that other property in Ohio, right? Hopefully those markets would not be experiencing the same downturn that we would be experiencing here in Florida. All right. Now, something else that we see investors utilizing 1031 exchange for is management relief. Now, I'll give you guys another example of maybe the way that could work. So I have a client. He lives in New York. All right. He owns 4 rental properties in New York. Now, what he would love to be able to do is he'd love to retire and he wants to move here to Florida. But you know what? He doesn't want to manage property anymore. So his ultimate goal is he'd like to be able to sell all 4 of those rental properties in one 1031 exchange, and then the replacement property that he purchases, he'd really like to maybe find maybe like a small apartment complex somewhere here in Florida that has some on-site management, right? Because hey, he doesn't want to manage property anymore. He basically wants to retire and he wants to collect a check every month. Well, 1031 exchange is perfect for somebody like him because he seeks that management relief, right? Now, another thing that we see investors utilizing 1031 exchange for is they actually will use 1031 exchange as an estate planning tool. Now, this is really a great aspect of 1031 exchange that honestly, it really doesn't get talked about that often. And hopefully, if you only remember one point from today's class, you remember this next point. All right. With 1031 exchange, you're not even limited how many times you can do a 1031 exchange, right? You could you could buy an investment property today, hold on to it for a period of years. When you go to sell it, do a 1031 exchange, defer your taxes, buy a replacement investment property. You could hold on to that property for a period of years. When you go to sell that, you could do another 1031 exchange, defer your taxes again, and buy another replacement investment property. You can keep doing that over and over and over through the entire course of your lifetime. Okay, now, when you die, when you pass on, if you have any heirs that inherit your property, your heirs are going to get a benefit that's referred to as a step up in basis, right? And basically what that means is whatever the value of the property is when they inherit it, that's their basis. That's their starting point, right? Any of those deferrals that would have been done from whomever they inherit the property for, they're not responsible for paying the taxes. So basically the taxes go away and no one ever has to pay the taxes, right? Now, what's the flip side of that equation? Well, I just mentioned you're not limited to how many times you can do a 1031, right? Buy an investment property today, hold on to it for a period of years, sell it in a 1031 exchange, defer your taxes, right? Buy another replacement investment property. Hey, hold on to that for a period of years, sell that in another 1031 exchange, buy another replacement investment property. But let's just say the next time you go to sell, you say, you know what? I have no desire to purchase any additional investment property. I have no desire to do any type of 1031 exchange. I'm just going to cash out. I'm going to pay whatever taxes are due. Now, you're going to be subject to whatever taxes are due on that transaction. And all of those previous 1031 exchanges where you deferred your taxes, you could also be subject to having to pay those taxes as well. Because notice how we term 1031 exchange as a tax deferral, all right? It's not a tax avoidance, it's a tax deferral. Deferral meaning that If you do not continue to do 1031 exchanges, you're going to be subject to whatever the taxes are. But remember the step up in basis, right? If you have heirs that inherit your property, they'll get that step up in basis. They're not responsible for paying the taxes. So hopefully no one ever has to pay the taxes. All right. I mean, as I mentioned, you know, it's a really great aspect of 1031 exchange that honestly it doesn't really get talked about that often. Now, I'll give you a scenario of maybe how the step up in basis could work. Let's just say I'm the heir, okay? I inherit the property, right? I get that step up in basis. Excuse me. The taxes go away. I'm not responsible for paying them, right? Now, for my own investment purposes, I may look at that property and say, you know what? That's a great property. I'm not going to sell it. Maybe it has some nice cash flow coming in every month, right? It's a rental property. Maybe I say, okay, for my own investment purposes, I'm going to hold on to it. Now, let's say I hold on to that property, I don't know, maybe like 5 years. And then after 5 years, I say, okay, now I'm ready to sell it. Now, if I have any gain from when I inherited the property where I got that step up in basis to when I go to sell it 5 years later, guess what? I can do my own 1031 exchange, defer my taxes, and basically start the whole process over. All right. So again, hopefully everybody remembers that point about using 1031 exchange as an estate planning tool, where your heirs will get that step up in basis. Okay. Now, what are current tax rates? Well, when you sell real property, if you have any gain in the property, you're going to be subject to capital gains tax. Now, capital gains tax right now is either 15% or 20%. Now, the 15% capital gains tax rate is applied if you're single and you have income of less than $492,000 a year, or if you're married and you have income of less than $554,000 a year, right? That's where you're at, the 15% capital gains tax rate. Now, the 20% capital gains tax rate is applied if you're single and you have income of greater than $492,000 a year, or if you're married and you have income of greater than $554,000 a year, right? That's where you're at the 20% capital gains tax rate. Now, on top of that, you would also be subject to an additional tax. It's referred to as depreciation recapture tax, right? That's an additional 25% tax. Now, you might be asking yourself, how does that work? What's that all about, right? Well, the depreciation recapture tax, it works like this. Any depreciation that you've claimed for the lifetime that you've owned that property, when you go to sell that property, they're going to hit you with a 25% depreciation recapture tax on the entire amount of depreciation that you've claimed for the lifetime that you've owned that property. All right. Now, on top of that, you may also be subject to an additional tax. It's referred to as the Medicare tax, right? That's an additional 3.8% tax. Now, you might be asking yourself, well, how does that work? What's that all about, right? Well, the Medicare tax, that was something that they passed back in 2010, all right, with the Affordable Care Act, you know, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act. All right. Now, the great news is when you do a 1031 exchange, you can defer having to pay any of these taxes. Right. Now, what am I not listing up on the slide? I'm not listing anything to do with state taxes. Now, for those of y'all that are located in a state like me in Florida, well, we don't even have any kind of state taxes, so we don't even need to worry about that. But if you live in a state or you're selling property that is located in a state that has state taxes, you would also have to be able to calculate whatever those numbers were. All right. The good news is when you do a 1031 exchange, you can also get out of having to pay those state taxes. Now, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state taxes. I'll give you guys a couple of examples, at least on exchanges that I was personally involved with. So we did an exchange for a gentleman. Now, he was a Florida resident, but he had an investment property located in California. Now, California has state taxes. their state taxes can be as high as I want to say it's like 11 or 12%. It's kind of like a tiered level. Like it's like the more you make, the more they tax you. Now, even though he was a Florida resident, but he was selling a property located in California, guess what? California was still looking for their state taxes. Now, the good news for him was he was doing a 1031 exchange, right? So he was going to be able to get out of having to pay those state taxes. Now, the way he got out of them is he had to complete the state of California form, and he had to submit it to the state. That's how he got out of having to pay those state of California taxes. Now, it's my understanding he's got to submit that form every year thereafter, right? The year he doesn't submit the form, they actually come after him for the taxes. Now, we did another exchange for a lady. She was another Florida resident. She was selling property, I believe it was in Maryland. Now, Maryland has state taxes. Now, good news for her, she was doing a 1031 exchange. So the way she was able to get out of having to pay those state of Maryland taxes was she had to complete the state of Maryland form. I think we even had to sign off on it. And I want to say she had to submit it to the state of Maryland. I believe it was like 20 days prior to closing. And that's how she got out of having to pay those state of Maryland taxes. So again, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state taxes, right? Hey, realtors on the line. I know we have a bunch of realtors on the line. You know, think about this for a minute. If that's your client and they're sitting there thinking, hey, they're going to have to cut a check for the federal taxes, right? And they might have to also possibly cut a check for whatever the state taxes are, and they're not talking about doing a 1031 exchange, hey, that's a perfect opportunity for you to bring it up to them, right? Because if they can save on having to cut the check for the federal and possibly the state taxes, what is that going to do for them? Well, it's going to give them much more buying power to go out there and buy a better property. If they can buy a better property, hopefully it's a higher dollar property for them. Also, hopefully that equates to a higher income producing property for them. And what's that going to do for you as a realtor? Well, if they can buy that higher dollar property, hopefully you just increase your commission. All but recommending a 1031 exchange. So hopefully some things to think about for everybody on the line today, right? Now, how do you actually calculate what the taxes are? Well, you know, this is typically done by a CPA, but I'm just going to walk you through a really quick example just to kind of give you an idea of how they calculate the taxes and what the potential taxes could be. All right, so in our example, originally we purchased our property for $500,000. Now, over the lifetime that we owned the property, we added back in $25,000 worth of capital improvements to it. Now, we took some depreciation, all right? For the lifetime we owned the property, we actually took $100,000 worth of depreciation, all right? Now, we're going to sell the property, all right? We're going to sell it for $1 million. So in order to calculate what the taxes are, the first thing you need to be able to do is you have to be able to calculate what they refer to as adjusted basis, right? And basically the way you do that is you take the original purchase price of $500,000, you add back in those capital improvements of $25,000, and then you deduct out the depreciation of $100,000, and that's going to give you an adjusted basis of $425,000. Now, how much are we selling it for? We're selling it for $1 million, right? So let's take that $1 million sales price. We'll deduct out the adjusted basis of $425,000, and that's going to give us a gain of $575,000. Now, in that number, how much of that is depreciation? $100,000, right? But we're going to deduct that out. We're going to take that $100,000 out because the depreciation recapture tax, that 25% tax that we talked about, that's actually calculated at a separate line item, all right? So we'll take the $100,000 out of depreciation, multiply it times the 25% depreciation recapture tax, and that'll give us a tax of $25,000. Now, how much do we have left over? $475,000, right? So let's just say we're going to be at the highest capital gains tax rate of 20%, all right? So we'll take that $475,000, multiply it times a 20% capital gains tax rate. That's going to give us a tax of $95,000. Now, let's also say we're going to be subject to the Medicare tax of 3.8%. So we'll take that $475,000, multiply it times a 3.8% Medicare tax. That'll give us a tax of $18,050, right? So when we sell this property, we would be looking at a tax bill of $138,050. Again, when you do a 1031 exchange, you can defer having to pay any of these taxes. Now, what am I not listing up on the slide? I'm not listing anything to do with state taxes, right? So again, remember, if you live in a state or you're selling property that is located in a state that has state taxes, you'd also have to calculate whatever those numbers are, right? Again, realtors, think about it. If that's your client and they're sitting there thinking they're going to have to cut a check for $138,050, and then whatever's left over, hey, now let's go find me some replacement property. And if you're the one that chose to them, hey, avoid having to cut that check for $138,050. Do a 1031 exchange, defer your taxes. Now let's go out and find you something even better, right? That's win-win all around, right? The client's going to win because why? Hey, they save on the taxes. And if they no longer have to cut that check or those checks, it just gives them that much more buying power to go out there and buy a better property. And hopefully it's going to be a higher dollar property and a higher income producing property for them, right? And you win as a realtor. Why? Because, hey, you look great to the client. And if they can buy that higher dollar property, you just increase your commission, all by recommending a 1031 exchange. So hopefully some things to think about for everybody on the line today, right? Now, what are some of the tax advantages when you sell real property? Well, let's recap. What type of real property can you do a 1031 exchange on? Well, any type of real property that you use in your trade or business or that you hold for an investment, right? Now, remember, it's a tax deferral. It's not a tax avoidance. Tax deferral meaning that what? You may have to pay the taxes someday if you do not continue to do 1031 exchanges. But remember that remember the step up in basis, right? If you have heirs that inherit your property, they get that step up in basis. And hey, hopefully no one ever has to pay the taxes, right? Now, what about your primary residence, your primary home? Can you do a 1031 exchange in your primary? Well, the answer is no, right? But the good news is you may qualify for what they refer to as a Section 121, right? And in order to qualify for the Section 121, you had to live in a property as your primary residence any 2 out of the last 5 years, all right? And if you do qualify, when you sell your primary, if you have any gain and you're single, the first $250,000 of any gain is tax exempt. And if you're married, the first $500,000 of any gain is tax exempt. Now, tax exempt meaning that you never have to pay it. It's not like a 1031 where it's some type of deferral. With the 121, it's an actual tax exemption. It's kind of like a one and done. Now, you don't need anybody like me to help you with the 121. That's just something that you claim on your tax return in the year that you sell your primary residence. Here's a quick example of the way the 121 can work. Let's say back in 2010, you go out and you buy your primary residence. Now, let's say you purchase it for $100,000. Now, you're going to live in it as your primary home for 5+ years. And then in 2016, you say, okay, I'm going to sell it. Now, you're going to sell it for $1 million. Now, I know, everybody, that was a great deal, right? I don't know if there's any deals like that anywhere here in the Tampa Bay area that I live in. But I don't know. Let's just say this is property maybe, I don't know, New York or California. But for our example, we'll keep the numbers really simple, all right? We're selling it for $1 million. We purchased it for $100,000. So our gain's $900,000. Now, I know that's not exactly how you calculate it, right? Because you got to calculate adjusted basis and everything else. But again, just for our example, we'll keep it really simple. All right, so we have that $900,000 gain. Now, it qualifies for 121 because we have lived in it, or actually greater than 2 out of the last 5 years as our primary home. Now, let's also say when we sell it, we're married, all right? So we're going to claim the 121. So what's going to happen is the first $500,000 of that $900,000 gain, well, that portion will be tax exempt because we're claiming the 121. But what's the problem? Well, we still have another $400,000 worth of gain that we're going to be subject to taxes on when we sell the property in 2016, right? That's going to roughly equate to about $130,000 in taxes when we sell the property in 2016. Now, hey, what if we could do this? What if in 2016, instead of selling the property, we actually have the ability to convert that property over to an investment property, a rental property, right? Now, let's just say we rent the property out for 2 years, okay? And then then we're going to sell it in 2018 after renting it for 2 years. Now, because we're selling it in 2018 and it's an investment property, guess what? It now qualifies for 1031 tax-deferred exchange, right? And in this example, we actually can do a combination of a 121 and a 1031. Again, to qualify for the 121, you had to have lived in the property any 2 out of the last 5 years as your primary residence. In this particular example, we did, all right? So let's keep all the numbers the same. We're still going to sell it for $1 million. We still have that $900,000 of gain. We're still married in 2018, so we're going to claim the 121. So again, what's going to happen is we'll claim the 121. So the first $500,000 of that $900,000 gain, that'll be tax exempt. Now, that additional $400,000 of gain, we're back in 2016 when we were selling it. We're going to be subject to taxes on that. Now in 2018, we'll claim the 1031 tax-deferred exchange on that portion of the gain, that $400,000. We'll defer those taxes. So when we sell the property in 2018, we pay no tax. Okay, pretty neat, right? Now this could also work. Let's say you want to go out and buy a double, a duplex. You want to live in half of it as your primary. The other half you want to rent out. Same thing. When you go to sell it, did you live in it any 2 out of the last 5 years as your primary? If you did, just to keep the numbers simple, hey, half of the gain, you claim the 121. That portion will be tax exempt. The other half, that was the investment side, the rental side, you claim at 1031, you defer those taxes, and you pay no tax. All right. Now, who can actually do a 1031 exchange? Well, it's really important to remember with 1031 exchange, all right, whoever the taxpayer is in the sale of the relinquished property, okay, that's the property that's being sold in a 1031 exchange, whoever that taxpayer is always needs to be the same taxpayer in the purchase of any replacement property or property, right? So individuals can do 1031 exchanges. Husband and wives can do 1031 exchanges. Spouses can do 1031 exchanges. Now, sometimes we see this with spouses. Let's say one of the parties owns an investment property prior to being married. I don't know, let's just say it's the wife, right? So she owns an investment property, a rental property, right, prior to being married. Now she gets married, and then during the course of the marriage, she decides she wants to sell the investment property. Now she wants to do a 1031 exchange because she wants to defer the taxes, and she wants to buy another replacement investment property, right? Now, in order to buy the replacement investment property, she needs to get a loan. She has to get a mortgage, right? Well, in order to qualify for the mortgage, she needs to bring her husband in because she needs his income to help her qualify for the loan. So how can you do that with 1031 exchange? Well, one possible solution would be is you might be able to take title to the replacement property as what's referred to as tenants in common. Now, hopefully everybody on the line knows what tenants in common ownership is, but if you don't, it's pretty simple. You can actually own a certain percentage of a property, all right? So what you might be able to do in this situation, now, in order for any of this to work, you'd have to get the lender's approval, obviously, but you might be able to bring the wife in. You make her a 99% tenant in common owner, and then you bring the husband in and you make him a 1% tenant in common owner of the replacement property. Again, if the lender would go for that, you get the loan approved, buy the replacement property, right? Which that brings me to the next point. Tenant and common owners can also do 1031 exchanges. I'll give you guys a quick example, maybe the way that could work. Let's say I want to go out and I want to buy an investment property, but I want to bring somebody else in with me to help me purchase it. Right now, we're gonna buy the property as tenant and common owners, where I'm gonna own 50% of it, and he's gonna own 50% of it. Right? So we buy this investment property, 50-50, tenant and common owners. Now we hold on to it for a period of years, and at some point we say, okay, we're ready to sell it. Now, for me, I'd like to take my 50% tenant and common ownership. I'd like to do a 1031 exchange because I want to defer my taxes and I want to go out and buy a replacement investment property. Now, my other tenant and common owner, he says, you know what? I have no desire to purchase any additional investment properties. I have no desire to do any type of 1031 exchange. I'm fine with just selling, paying my taxes. Well, he has the option to do that. Just like me, I have the option if I want to take my 50%, do a 1031 exchange, defer my taxes, buy a replacement property. I can do that. Now, if he wanted to, he could take his 50% of his tenant in common ownership, do a 1031 exchange on his 50%, defer his taxes, and he could go out and buy his own investment in replacement property. Okay, so again, tenant in common owners can do 1031 exchanges. Any type of legal entity that owns real property can do an exchange, right? Corporations, trusts, partnerships, LLCs. Okay, sometimes we see this with LLCs. For tax purposes, the LLC is what's referred to as a disregarded entity. Now, disregarded meaning that you don't file a separate tax return for that LLC. Anything to do with that LLC, you just put on your personal taxes, right? It's common that we see this with just maybe like single member LLCs. Some of y'all on the line for your real estate businesses, right? You might have an LLC for your real estate business, right? Well, what do you do at the end of the year? You don't file a separate tax return for that LLC, right? Anything to do with that LLC, you just put on your personal taxes, right? Well, again, that's referred to as a disregarded entity because, excuse me, that LLC and you as an individual are considered one and the same for tax purposes. Because why? Because it's all being reported under one tax return. So sometimes we see this, excuse me, somebody will own a property in their individual name, right? They sell it in a 1031 exchange, and then the replacement property, they actually have the option to purchase it in their individual name, or they can even purchase it in their disregarded entity, their disregarded LLC. Now, it works just the opposite way too. Sometimes we see people own a property in their disregarded LLC, they sell it in a 1031 exchange, well, they have the option to purchase it in the name of that LLC, or they could actually purchase it in their individual name. You know, sometimes the reason they have to purchase it in their individual name is because they're getting a loan. And, you know, some lenders, they don't like loaning to LLCs. They like loaning to individuals. So that forces clients sometimes to have to purchase property in their individual names. And they can do that, all right? And sometimes we even see this. Let's say somebody wants to go out and they want to buy an investment property, and it's located on, I don't know, 1234 Main Street, right? So what do? Well, they go out and create an LLC called 1234 Main Street LLC. That's going to be a disregarded entity, meaning that they're not going to file a separate tax return for that LLC, right? Anything to do with that LLC, they're just going to put on their personal taxes, right? Again, that's a disregarded entity. So they buy 1234 Main Street in the name of 1234 Main Street LLC. It's an investment property. They hold on to it for a period of years. They go and sell it in a 1031 exchange. The property they're going to purchase is going to be 5678 Central Avenue. Now, they don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do in that case? Well, they go out and create 5678 Central Avenue LLC. That's also going to be a disregarded entity, meaning what? They're not going to file a separate tax return for that LLC, right? Anything to do with that LLC, they're just going to put on their personal taxes. Well, they can do that, right? Because all of those disregarded entities, those disregarded LLCs, are considered one and the same with each other, and they're also considered one and the same with the individual because it's all being reported under one tax return. So as I mentioned, with 1031 exchange, always remember, whoever the taxpayer is in the sale always needs to be the same taxpayer in the purchase of any replacement property or properties. Now, if it's a regarded entity where the actual entity itself files a separate tax return, if that entity owns the real property, that entity needs to sell the property in a 1031 exchange, and that same entity needs to purchase the replacement property, right? Because it has to be same taxpayer in the sale, needs to be the same taxpayer in the purchase of any replacement property or property, right? Now, what type of property is excluded from 1031 exchange? Well, your primary residence, right? We've already talked about that. What do you do for your primary? Well, you might qualify for the Section 121, right? But primary residence is excluded from 1031. A property held for sale is also excluded from 1031 exchange. I'll give you guys an example, maybe the way that could work. Here in Florida, we have a lot of these national home builders like Pulte Homes, Lennar Homes, KB Homes. Let's say I'm Pulte Homes. Now, Pulte, they're one of the largest single-family residential home builders in the entire country. They're a publicly traded company. They build newly constructed properties throughout the United States, multiple states, right? Well, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and not for investment, they can't do 1031 exchanges on those types of properties, all right? So property held for sale is excluded from 1031 exchange. Now, dealer property is also excluded from 1031 exchange. Now, you might be asking yourself, what is dealer property, right? Well, dealer property, that might be somebody that we most often refer to as a flipper. They buy a property today, I don't know, 2 or 3 months goes by. During that 2 or 3 month period, they fix the property up. And then when it's completed, what do they do with it? Well, they turn around and sell it as well. Well, they can't do 1031 exchanges on those types of properties, all right? Because that's like their business. That's like their inventory, all right? They're in the business of buying properties, fixing them up, and turning around and selling them. Well, you can't do 1031 exchanges on those types of properties. Now, here's a possible solution for a flipper. Let's say they buy a property. Again, I don't know, 2 or 3 months goes by, they fix it up. But when it's completed, they go to their realtor and they say, hey, can you put this in the MLS system showing it for rent? Now, let's make sure we put it in there for fair market value rent as well. Well, that's a little bit different, right? Because now all of a sudden, what are they doing? They're showing that their intent is to hold the property for investment and not for sale. I mean, I don't know, who knows? Maybe they even show it to a potential renter. They run some type of credit check on that potential renter. Yeah, I don't know, they don't have such great credit. They decide not even to rent it to that potential renter. If that flipper ever gets audited and the IRS comes in and says, okay, prove to us you held that property for investment and not for sale, they're going to have to be able to back it up, right? And there's a good shot they could. In the example I just gave you, they said, look, here's an email that I sent to my realtor on such and such a day requesting that they put it in the MLS system for fair market value rent. Here's the MLS listing showing it for fair market value rent. Here's the day I showed it to that potential renter. Here's the credit check on that potential renter. All of that type of stuff is going to be what? It's going to be their proof, their backup, right? That their intent was to hold it as an investment rather than for sale. But remember, everybody, however long it takes them, they buy a property, and however long it takes them to fix it up, when it's completed, if they turn around and sell it, you can't do 1031 exchanges on those types of properties. All right. Now, foreign property is also excluded from 1031 exchange. Here's an example. Let's say I own an investment property here in Florida. I sell it in a 1031 exchange, but I can't go out and try to buy replacement property, let's say somewhere like Canada or Mexico or Europe. Okay. It has to be property located where? It has to be property located anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. right? So foreign property is excluded from 1031 exchange, okay? Now, what are the tax deferral requirements? So in order to get a full deferral, rule number one is you need to reinvest all of the net proceeds in property of equal or greater value. So what exactly is the net proceeds? Net proceeds, that's the cash, right? That's the cash that normally you would get out of the closing. Now, we're the qualified intermediary, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, right? Because the rule is they can never have receipt of those funds. If they ever do, they would lose their ability to do a 1031 exchange, right? So they can't close today, call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange, right? At that point, it's too late, all right? They couldn't even close today, leave the office of the title company, escrow company, attorney's office, right? Leave their office, get in their car and call me from the car and say, hey, Jeff, I want to do a 1031 exchange, right? Because their funds might be sitting in the escrow account where they did the closing, right? That company's escrow account. They might be waiting to wire those funds out to them. At that point, they have what's referred to as constructive receipt. They have a legal right to the funds. They've lost their ability to do a 1031 exchange, right? So we have to get involved prior to the closing, basically prior to them walking out the door, right? Now, that's rule number one. All right, we're going to hold the proceeds on behalf of the seller, the exchanger. Now, rule number two is if you have any debt, if you have a loan that you're paying off, a mortgage, whatever the payoff amount is, you actually are required to obtain an equal amount or greater debt in the purchase of any replacement property or properties. Now, that rule can actually have an exception, right? If you have cash that you're willing to use towards buying your replacement property, you can offset that rule of obtaining an equal amount or greater debt. Now, obviously, if you don't have any debt, if you don't have a loan that you're paying off, well, you're not required to obtain a loan in the purchase of your replacement property or properties, but you do have the option, if you need to or if you want to help you buy your replacement property. How do the numbers work? Here we go. Here's a quick example. In our example, let's say we're going to sell our relinquished property for $1 million. Okay, so we're going to sell it for $1 million. Now we have debt. We have a mortgage that we're paying off. The payoff amount is $300,000. So we'll take that $1 million sales price, deduct out the debt, the payoff, mortgage payoff of $300,000. Now we have some costs associated with the closing. That's going to be like real estate commissions, title insurance, closing fees, some of those non-reoccurring type of fees. Let's say that's $50,000. We'll deduct out that number. That's going to leave us with net proceeds of $650,000. Now, again, we're the qualified intermediary, the QI. We're going to hold that $650,000 on behalf of the seller, the exchanger, right? Because they can never have receipt of those funds. Now, what are they going to do with that $650,000? Well, in this example, they're going to use that entire amount towards the purchase of a property of greater value. They're actually going to buy a property for $1.2 million. All right, so they just met rule number one, right? Because they're using all of the proceeds from the sale, and then in this example, they're actually buying a property of greater value because the property they sold was $1 million, right? They sold it for $1 million. The new property that they're purchasing it for $1.2 million. So they just met rule number one. Now, they still need another $550,000 to help them buy that property for $1.2 million. So what do they do in that case? Well, they go out and get a loan for $550,000. Now, by doing that, they just meet rule number two. Because why? Because the loan that they paid off, the payoff amount was $300,000. In this example, they actually obtain greater debt, right? Because the new loan is $550,000. If they do this, they'll get a full deferral. They'll defer their taxes 100%. Now, remember I told y'all, rule number two can have an exception. If you have cash, you can offset that rule. So let's just say they say, well, we don't want to get a loan for $550,000. Okay, well, then what are your options at that point? Well, if they had $550,000 cash that they were willing to use towards buying their replacement property, that would have worked for them. All right. Or they may have said this. They may have said, well, we do have some cash that we're willing to use towards buying our replacement property. And then the difference, we'll make that up in a loan, a mortgage. Well, that would have worked for them as well. All right. So any of those scenarios would work. Now, what if they wanted to do this? What if out of the $650,000, they say, well, you know what? We don't want to use all of that towards buying a replacement property. We want to take $100,000 of the $650,000 and we want to hold that back. And we only want to use $550,000 towards buying our replacement property. Well, you can do that with 1031 exchange, but that $100,000 that you hold back, you're going to be subject to taxes on that amount. All right, that's actually referred to as cash boot. Now, it doesn't mean you can't do a 1031 exchange. It just means that instead of you getting a full deferral, you're going to get what's referred to as a partial deferral. Now, partial, why? Because you're going to be paying some taxes on that $100,000, right? Now, typically the tax you pay on that cash boot, the $100,000, it's going to be significantly less than if you just sell the property outright and you don't do any type of 1031 exchange. Okay. Now, the $100,000 that you hold back, you can do whatever you want with those funds. I mean, if you want to pay off bills, you want to go on a great vacation, you got a child starting college, you want to pay for college. I mean, I don't know, you want to go to Vegas, you want to blow it all gambling, all right? Again, whatever you want to do with that $100,000, you can do, but you're going to be paying some taxes on it, all right? Now, back to the example. So we're only going to hold $550,000. Now, in this example, they're going to use that entire amount towards going out and purchasing a replacement property of $800,000. They're going to go down in value. Now, they still need another $250,000 to help them do that. So what do they do in this case? Well, they go get a loan for $250,000, but by only getting a loan of $250,000, they actually go down in value, down in debt by $50,000, right? Because the loan that they paid off was $300,000, and the new loan for the replacement property was $250,000. So that $50,000 of less debt, they're also going to be subject to taxes on that amount. All right, that's referred to as mortgage boot. So there's two types of boot. There's mortgage boot and there's cash boot. Again, it doesn't mean you can't do a 1031 exchange. It just means that you're going to get a partial deferral instead of a full deferral, right? Again, typically the taxes that you pay on the boot are going to be significantly less than if you just sell the property outright and you don't do any type of 1031 exchange, right? If anybody ever wants to do anything like this, I always tell them, I say, look, you really need to sit down with your CPA and you got to go over all of your numbers, right? Because you have to look at it two ways. You have to look at it and say, okay, if I don't do any type of 1031 exchange, if I just sell my property outright, well, what do my taxes look like? Now, if I sell my property, but I do a 1031 exchange, but I pay some taxes on boot, well, what do my taxes look like, right? Again, usually those taxes are going to be significantly less than if you just sell it outright. But if your CPA comes back and says, you know what, the taxes that you're going to pay on boot, they might be about the same, or they might even be greater, then it's probably an easy decision for you. Don't do a 1031 exchange. You're going to lose money, all right? So always talk to your CPA before you do anything. Make sure you know your numbers, all right? Now, there's actually some timelines with 1031 exchange that everybody needs to be aware of, all right? So from when you close on your relinquished property, from the closing date, from the property that you're selling, from that date forward, you're going to have 180 calendar days to purchase any replacement property or properties. And it's calendar days, right? It's holidays, it's weekends. Hey, I live in Florida, all right? From June 1st to November 30th is what? It's hurricane season, okay? So if we're getting hit with a hurricane and everything's shutting down for a day or two or a week, whatever it may be, None of that matters with 1031 exchange, okay? That clock is always going to be ticking. So everybody keep that in mind, right? Now, the first 45 days of the 180 days is what's referred to as the identification period. Now, what exactly does that mean, right? The identification period. Well, what that means is you must identify any potential property or properties that you want to buy. Now, none of those properties even need to be under contract. You just have to identify any potential properties you want to buy. That's something else that we're going to assist with, all right? We're going to provide to the client a form. Now, we refer to it as the identification ID letter. And basically, it's going to have some blank lines on it. It's going to have to be specific to a property address or addresses, okay? Client's going to have to fill that out, sign it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property. They're going to do it directly to us, the qualified intermediary. Here's the thing about the 45 days. Let's just say they happen to find that perfect property, but it happens to be day 46. Okay, at that point, it's too late. All right, so whatever they put on that form by midnight of the 45th day, they're going to have to make sure they're going to be able to purchase at least one of those properties. And when do you have to purchase it by? You have to purchase it by day 180. There is no extensions to the timelines. There is no exceptions to what you identify, all right, on that form by midnight of the 45th day. Let's just say you identify 3 properties, all right? You put it on the form, you sign it, you turn it into us by midnight of the 45th day. Now, if after midnight of the 45th day, I don't know, one of those properties sells, there's no going back and saying, hey, one of those properties I identified, one of them just sold. There's no way I could ever buy that property now. It doesn't matter. All right, you're locked into buying at least one of those other properties, one out of the 2 remaining properties. Right? If you're unable to purchase any of those properties by day 180, you're going to blow your exchange and you're going to be subject to all of the taxes. All right, so everybody keep that in mind. There is no exceptions. There is no extensions to any of the timelines. Now, there's actually some rules to identifying, and I'm going to read each one of the rules to you. And if you don't quite understand them when I read them to you, don't worry about it, because I'm going to walk you through the numbers, give you some examples of how the numbers work, and hopefully once I show you how the numbers work, it'll make sense to you. All right, so the most popular rule that we see investors enacting is referred to as the 3-property rule. 3-property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean, right? Fair market value? Well, if you identify 3 properties or less, the purchase prices can be any dollar amount. It does not matter as long as you identify 3 properties or less, okay? Those purchase prices can be any dollar amount. Now, hey, if you want to identify more than 3 properties, you can do that with 1031 exchange, but it's going to put you into this next rule. It's referred to as the 200% rule. And the 200% rule states this: you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean, right? Well, what that means is if you identify more than 3 properties, the combined purchase prices of all 5 of those properties cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, all right, the relinquished property. Now, if you want to identify more than 3 properties, you also want to exceed the 200% rule, well, you can do that as well with 1031 exchange, but it's going to put you into this next rule. It's referred to as the 95% rule. Now, it's very rare that we even see investors enacting this rule, all right? Honestly, it doesn't make a lot of sense in the way that it's written, but remember, everybody, this is the IRS, and sometimes this stuff just doesn't make sense, right? Because it reads like this: you can identify over 3 properties, and you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified, right? Now, I know that's probably about as clear as mud, okay? Um, Let me show you other examples, especially with this last one, the 95% rule. And hopefully, once I show you the examples, it'll make sense to you, okay? All right, so here's the three property rule. Again, if you identify three properties or less, the purchase prices can be any dollar amount. It doesn't matter, as long as you identify three properties or less. So here's an example. Let's say we sell our property for $1 million, right? Now we go out and we identify three properties, all right? Because we've identified three properties, we're in the three property rule, right? Now let's keep the math really simple. Let's say we're going to buy each one of those properties for $1 million each. So we've identified how much in property? $3 million worth of property. Now, again, because we're in the three property rule, we could be buying those properties for any dollar amount. We could be buying them from, I don't know, $10 million each for a total of $30 million in identification. Again, as long as it's three properties or less, the purchase prices can be any dollar amount. It doesn't matter. But what does matter? Well, I'll say it again. If you identify three properties, boy, you better make sure you're going to be able to purchase at least one of those properties, right? So, what's the best way to lock up a property? Well, to put one of them under contract. Now, again, you're not required, as far as the identification rules go, to put any properties under contract. But in practice, what we typically see an investor doing is they will put a property under contract. That's one of the properties they identify. Then I don't know, maybe they'll identify two other properties that are not under contract, because what could potentially happen is after midnight of the 45th day, if the property that they do have under contract, if that whole deal falls apart, okay, at least they'd have the opportunity to purchase those two other properties that they would have identified, right? So that's the three property rule. Now, here's the 200% rule. This is where you exceed the three property rule, but you cannot exceed 200% or two times the combined fair market value of the property being sold. So here's how it works. Again, we sell for $1 million. Now, in this particular example, we actually go out and we identify 5 properties. Okay, because we've identified 5 properties, what just happened? We exceeded our 3 property rule, right? So that's going to put us into the 200% rule. So what exactly does that mean? Well, what that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you might be asking yourself, where is he getting the $2 million from, right? Well, we sold for $1 million. So 200% of that $1 million sales price, or 2 times that $1 million sales price, is how much? $2 million, right? So I think this one is pretty straightforward. Hopefully everybody gets it, right? Now, here's the 95% rule. This is where you exceed the 3 property rule, you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. So here's how it works. Again, we sell for $1 million. Now, in this example, we actually go out and we identify 10 properties, right? Because we've identified 10 properties, what just happened there? We exceeded our 3 property rule, right? Now, let's keep the math really simple on this one as well. Let's say we're going to be buying each one of those properties for $1 million each. So how much have we identified in property? $10 million worth of property, right? Because we've identified $10 million worth of property, what just happened there? We exceeded our 200% rule, because that was how much? $2 million. So that's going to put us into the 95% rule. So let's just say, in our example, we're only able to purchase 9 out of the 10 properties that we identified. Well, that's only going to be 90% or $9 million. That is not 95%, right? If we do that, if we're only able to purchase 9 out of the 10 properties, guess what's going to happen? We're going to blow our entire exchange, and we're going to have to pay all of the taxes, all right? So in practice, the 95% rule, the way it works is really 100% of whatever you identify, you're going to have to buy. And we're using really simple numbers, right? We're saying, hey, each one of those purchase prices, they're going to be $1 million each. You know what? Those purchase prices, they're going to be all over the map, right? It's going to be really hard to sit down and say, okay, let's see, if I buy this property, oh, wait, that's only going to put me at 93%. All right, maybe I need to make sure I purchase this other property. Oh, wait, that's only going to put me at 94%. All right, so again, in practice, the way the 95% rule works is really 100% of whatever you identify, you're going to have to buy. All right, the IRS wants to limit you in how many properties you can identify. They don't want you going out there identifying everything under the sun, because you know what's going to happen if you identify everything under the sun. You're going to have to buy everything under the sun because of this crazy 95% rule. All right, again, we don't really see it enacted that often, but just realize, everybody, it does exist and it is out there. Okay, now there's a few different type of exchanges. The most common type, it's everything we talked about today. It's referred to as a delayed exchange. Another term you hear people refer to it is a forward exchange. Okay, it's where you sell first, you sell your relinquished property first, and then you buy last. You're buying by day 180. Again, that's the most common type of exchange we do, a delayed or forward exchange. We cover that in greater detail in our basic class. But there's a few other type of exchanges. There's another one that's referred to as a reverse exchange. Now, the reverse exchange works just the opposite of a delayed exchange. It actually gives you the ability to buy first, to buy your replacement property first, and then sell last, sell your relinquished property last. Now, excuse me. The thing with 1031 exchange is you can't exchange into something you already own. All right. So what typically happens where people do the reverse exchanges is, let's say you have your property listed for sale. Okay. Now, maybe you don't even have a contract on it yet, but you go out and you find the perfect replacement property. And you know, if you don't act fast, you're going to lose out on being able to purchase that perfect replacement property because, I don't know, hey, maybe it's a seller's market, right? Properties are turning over really quickly. And you know, hey, if you don't act fast, by the time you sell your relinquished property, that perfect replacement property may already be sold. All right, so what can you do? Well, you can do this thing called the reverse exchange. Now, what happens in the reverse exchange is we actually come in and we form a separate company. It's referred to as an exchange accommodating title holder, EAT for short. We come in and we buy the replacement property before you sell your relinquished property. Now, when we do that, okay, when we purchase the replacement property, you must be able to sell your relinquished property within 180 days. So there's the 180 coming back into play. It never leaves with 1031 exchange. It's always going to be in some form or fashion. All right. What are some of the positives for the reverse exchange? Well, in a seller's market, you know, as I mentioned, you got to act fast, be able to secure that perfect replacement property. You can do the reverse exchange. Now, sometimes we see this, and some of the realtors on the line today, y'all may have had clients like this in the past. You might have one like this right now. You know, they list their property with you, right? And they say, well, my property is the greatest property in the world, right? I'm not going to have any problem selling it. So what do? Well, they go out and they put a contract on a replacement property, right? And then slowly but surely, what happens? Reality starts to set in, right? And they realize maybe I don't have the world's greatest property because I'm not getting all those showings like I thought I was going to get. I'm not getting all those offers like I thought I was going to get. But guess what? They already have a contract on that replacement property, and that closing date is fast approaching. They're obligated to buy that property, right? So what can they do to save that whole deal? They do the reverse exchange, okay? Now, what's the biggest negative, the biggest obstacles to overcome with the reverse exchange? Well, we're a great company, but we're not just going to come out of pocket and buy the replacement property, all right? The client is going to have to be able to give us the financing in order for us to do that. Now, typically, it's going to have to be cash. Now, the reason I say cash is because if they're trying to get a loan through a traditional lender, a mortgage company, a bank, typically lenders are not going to loan funds at that point because why? Hey, we're not the borrower, the client is, right? We're actually going on title, the client is not. All right, so that's why I say typically it's going to have to be cash. Now, I don't know, maybe they have some kind of great banking relationship. They can get some type of line of credit. Some people tell me, hey, some of these hard money type lenders, they'll do deals like that all day long. For us, it really doesn't matter. Just some way, somehow, they have to be able to give us the financing in order for us to buy the replacement property. All right, now what's the other negative? Well, you have to be able to sell your relinquished property within 180 days. Now, what if you can't do that? Well, come day 181, you're going to own an additional property. Now, you're not going to have any capital gains taxes or anything like that to pay, right? Because you never sold anything. Now, the client might sit there and say, well, I still want to sell my relinquished property, my investment property. You can still do a 1031 exchange, but you're going to have to designate a new replacement property because the original replacement property, you already own that, right? And as I mentioned, with 1031, you can't exchange it to something you already own, all right? So that's how the reverse exchange works. Now, there's another type of exchange. It's referred to as a construction exchange. Another term you hear people refer to it is an improvement exchange. Another common term is maybe even like a built-to-suit exchange. They can work something like this. Let's say you sell your relinquished property in a 1031 exchange, right? Now, we're the QI, qualified intermediary. We're going to be holding the proceeds from that sale. Now, the client goes out, they find a replacement property, but they want to do some improvements to it before they actually acquire it. So what can they do in that case? Well, they can do this thing called the construction improvement or built-to-suit exchange. Again, we come in, we form that EAT. We can take the proceeds that we're holding from their sale. We can take those proceeds and then we buy the replacement property and then we oversee the improvements. Now, we're working hand in hand with the client, right? But as far as the disbursements go, contractors or subcontractors that need to be paid for the services, throughout the construction process, we would handle all of that. Now, those improvements need to be done within 180 days, right? So again, there it is. There's the 180 coming back into play. As I mentioned, it never leaves. It's always going to be around in some form or fashion, all right? What do we charge for our services? What's our fee? All right, well, for the delayed exchange, again, most common type of exchange where you sell first, you sell your relinquished property first, you buy last, you're buying your replacement property by day 180, we charge a flat $12.50, all right? We don't collect any type of setup fees. We don't charge any type of wiring fees. We like to get the process started once a contract gets signed and the property being sold, okay? We prepare documents, an exchange agreement, we forward that over to whoever's handling the closing. Those documents sit there waiting for the closing to happen. If for some reason the closing never happens, the contract falls apart, the buyer walks, or the seller, the client decides at the very last minute, they've had second thoughts, they're not going to move forward with any type of 1031 exchange, we don't even charge any type of cancellation fees, right? Our $12.50 is not incurred until the day of closing. Just like, if you're a realtor, you don't earn any type of commission until the file closes. Well, our fee is not incurred until it closes, all right? And our fee, the good news is it covers the sale of one property, and actually it covers the purchase of up to 3 replacement properties. That's it. There's no other hidden costs, hidden fees, or anything like that. Now, the reverse exchange, construction improvement, built-to-suit exchanges, those can be significantly more complicated than a delayed exchange, all right? We're forming a separate company. We're going on title. In the construction exchange, we're working with contractors, okay? Again, those can be significantly more complicated. Our fees for those types of exchanges, they start off at $8,500, all right? Remember in the very beginning, I told y'all one of the owners of our company was a tax attorney, Adam Skarsgård. He personally handles any reverse construction improvement exchanges that we do. He looks at each one of them individually, decides on how complicated they are, and bases our fee off of that, all right? That's it. We're done. I'll open the floor up to questions. If anybody has any questions, there's a box that says questions. Feel free, type your questions in. As we're waiting for questions to come in, I'll mention this to everybody. Today's presentation was recorded. You'll receive a link to today's recording if you want to refer back to any of the topics that we discussed. And then, as I mentioned, some of the topics we covered here and there, I have in just like PDF form. I'm going to email those out to everyone, right? Like I said, if you're a realtor, you have a client that has a 1031 exchange need, feel free to forward that email on to your clients. If you want to include me on the email introducing me to your client, that way I can follow up with any questions they may have. I'm glad to do it. All right. Don't feel like you have to go about this alone. I want to be a resource to everybody on the line today. If you have clients who have 1031 exchange needs, you are individually, if you're an investor, I'd be glad to talk to you. Right. I talk to people about 1031 exchange all day long. All right. And today's class was an advanced class. Our prior class was a basis class. That's an hour class. Today is like an hour and 15 minutes. I do have an additional class coming up later this month. It's called Discovering 1031 Exchange. If you happen to be a Florida realtor, it's going to be worth 2 continuing education hours. All right. It's a 2-hour class. It's kind of like the basis class and today's class and even more information. Okay. If you want to join in on that, please let me know. Or you should have received the link for today's class, the registration. It should have been in that same email. If not, reach out to me. I'll send you the information. A lot of my classes I do for individual real estate offices, boards of realtors, title companies. If you feel like other people in your office could benefit from one of my classes, let me know. I have a PDF I can forward over to you. If you're the decision maker or you have to forward on to the powers that be, let me know. We could get something set up. I can do a webinar for you guys. All right. All right, let's see. We have a question here. Let's see. If a Florida rental properties are in an LLC, how do you pass those along to your heirs? Can they be transferred into a 1031 exchange and then decide if they want to keep the property or sell property, another property later? All right. So if it's in an LLC, again, if it's disregarded, I believe it would all fall under you as an individual. So that's how your heirs would inherit the property. Now, if it's a regarded where you have partners, it wouldn't fall under your heirs, I believe. Or they might get a portion of whatever your shares were in the LLC. Again, that's a really, really good CPA question. I'll defer that to the CPA to answer that type of question, or the estate planning attorney. But I believe if it's a disregarded LLC, it's all considered one and the same. So that's how your heirs would inherit the property. All right. It could also be a trust. If they're the beneficiaries of the trust, they would inherit the property and get the step up in basis. All right. Let's see. If seller closed on the relinquished property, your company is holding the proceeds, but the seller never goes through with purchasing any of the identified properties, how long in the process to get their funds back? All right. So if somebody sets up the 1031 exchange with us, if they identify replacement property, they turn in the form to us by midnight of the 45th day. Okay. Believe the code states that we have to hold on to their funds until day 180. All right. Because the thinking is, if they identify 3 properties, let's just say on the form, they still have the ability during that time period to buy those 3 properties, right? So we would have to hold on to the proceeds until day 180. Now, if they don't identify any properties by midnight of the 45th day, then come day 46, their exchange is over with. We can refund the proceeds to them, less the $1,250 that we would have charged them at the closing. Right? If prior to the 45th day, if they say, well, hey, I decided I'm not going to move forward with it, I just want to cancel it, our policy is we would actually provide a cancellation form. They fill out the form. We would return the proceeds, again, less the $1,250. The $1,250 would not be refundable at that point. Once we set everything up, we charge it at the closing of the relinquished property. It's non-refundable at that point if for some reason they cancel their exchange or they're unable to complete their exchange. Okay, hopefully that makes sense. If you have a question that's a little bit more complicated than typing into a box in like 20 seconds, I totally get it. Shoot me an email, give me a call. We can talk offline. I totally get that. All right. Okay, well, I think that's all the questions coming in. Yep, we had 2 questions. Okay, well, again, if anybody has any other questions, shoot me an email, give me a call. Again, I'll be a resource for you. Oh, I mentioned this too. Some of the information I have in Chinese and also Spanish. If you want those additional PDFs in the other languages, let me know. I'll get those over to you. All right. But we'll go ahead and wrap it up for today. Thanks, everybody. Thanks for hanging in there. We went over a few minutes later than than we anticipated, but hopefully I answered all your questions. And please, again, I want to be a resource for everybody on the line today. Please reach out to me. Hopefully we'll talk soon, but please stay safe, stay healthy, and enjoy the rest of your week. Thanks for joining today.